I'm Ben Clark, and today we're going to be talking about how the professionals are investing in what looks like a continual deteriorating economic backdrop. It's pretty challenging out there, but there are ways to combat it, and we've got David Keelan from Ellerston and Martin Hickson from WAM. Martin, I might start with you. I've seen a couple of the big offshore professional investors coming out here, doing the rounds, and seemingly in some cases sort of scratching their heads, sort of thinking the pessimism is a bit unusual given our economy is performing a lot better than most. Is there cause for concern out there?
I mean, the economy has been performing well, but it definitely is slow. We've seen that through the recent reporting season. We saw a number of companies that are exposed to the consumer issue earnings downgrades or softer first half results. So the economy definitely is slowing, and we're very wary of that at WAM.
Yeah. So how much of that do you take into account when you're constructing your portfolios, when you're looking at investing?
At the end of the day, we're bottom-up stock pickers. We're trying to identify growth companies with a catalyst that will re-rate it. However, we definitely take into account what is happening in the domestic economy. We've seen significant slowdown, which is affecting retail stocks, housing stocks. The wealth effect from falling house prices is definitely starting to bite. So it is a part of our investment process, but the key part is looking for those undervalued growth companies that will re-rate based on a catalyst. Okay.
And David, I could turn to you. I saw the 10-year bond yield went under 2% today, which is almost the lowest it's been in this cycle. The bond market is saying there's cause for concern. Are you concerned?
We think we're closer to the top of the cycle than closer to the bottom. But picking absolute tops and bottoms is a dangerous thing for a bottom-up stock picker. So we tend to try and tilt our portfolio so that overall the portfolio is net cash. Not many companies with debt. Less than 3 of our stocks are not able to fund themselves via free cash flow. So we just take a more pragmatic approach to the companies that we're selecting at the moment.
Okay, and so we've been through February. We've all heard from a lot of different businesses. Is there any sort of areas of the market that you call out, that you've seen the economy is really starting to impact on the business?
I think Martin is correct. Consumer is extremely patchy, and to own anything in that environment, there needs to be a strong reason.
Yeah. Okay. And okay, so Martin, we know that area of the economy is weak. Is it more about what's happening now, or is it more about concern about the outlook for where we head from here? Do you feel like it's actually having much of an impact now?
A lot of it's about the outlook. I mean, we saw in-line results from JB Hi-Fi and Super Retail. However, both share prices fell over 3% in February versus the market up 6%. So their outlook statements were a little bit softer. We saw a large downgrade from Bingo. They were guiding to 15 to 20% growth, downgraded to flat growth, saw the share price fall 50%. They're being impacted by weaker residential construction volumes and less waste. Okay. Stockland, Lend-Lease, Mirvac also pointed to slowing residential house sales in the first half. They are talking about a pickup in the second half, which we think is unlikely given house prices are continuing to fall.
Okay, and so, it sounds like there is cause for concern there, but there are businesses that can do well despite all that. So when you've got them coming in, post their presentation, what are the traits that you're sort of looking for in a company that you think can steer you through this environment?
We're looking for, a lot of what we're looking at the moment is stocks with an offshore growth angle or a structural growth angle where they can grow irrespective of what the domestic economy is doing. One such example is Infomedia. They've got a large technology business focusing on electronic catalogues for car dealerships and OEMs. 80% of their revenue comes from offshore. 95% of their revenue is recurring. So we think that they can grow despite what's happening here in the domestic economy in Australia. Okay.
David, anything you can add in terms of traits? I mean, looking at companies with offshore exposure seems to be a pretty common theme now. Domestically, is there anything that you'd be looking for that you think can continue to grow? And you got an example for us?
Yeah, we're looking for businesses that have a reason to grow and have some kind of structural force behind it other than the normal level of cyclicality. Yeah. One company that we like and has done pretty well this reporting season is Megaport. Megaport is solving a problem for data centers. So a capital-light business is solving a problem for a capital-heavy business. The valuation is high, and it's one of our only companies that isn't free cash flow profitable at the moment. But given the growth rates and the management and the board, we're a believer they can go on to capture a lot more of the market.
Okay. So it looks like a pretty tough economic environment. Might get worse from here, but there's always some things you can have a look at that can make you some money.